So we're only doing a portion of Chapter 7. Chapter 7 goes into a lot more detail regarding cash and so forth. But actually, what's the most important part that every business person, every business student really has to understand is the issue of fraud and what the government requires corporations to do, which is to try to set up systems inside their business to reduce the likelihood of fraud. Okay, so much of what we're going to be doing in this chapter is revolved around fraud and internal controls to prevent fraud from happening. And as such, we're going to be focusing in on learning objective 1 as the main part. So let's start from the beginning. They start with a definition of fraud that is limited, because fraud is a big category. Could be a lot of different things. But in essence, we're working with this definition. Okay. Fraud as a dishonest act by employee that results in a cost to the employer. Okay. So this is how we're looking at this from a very narrow definition here. So again, the employee benefits, but the employer does not. It comes at a cost to them. So your book has identified, properly so, factors that contribute to fraud or fraudulent activity. Number 1 is at the very, very top. Opportunity. Now, it's interesting that this particular topic of fraud shows up in the cash chapter. Chapter 7 is really talking, much of it is about cash. Well, isn't cash the most handled asset at most businesses? Outside of inventory, if it's a retail store, cash is a very common asset that's going to be handled. And of course, your employees are going to be handling cash because you're going to need to hire folks who are cashiers, for example, or if it's a bank teller, type of thing, which we're handling cash. You might have other staff, say, in a restaurant, waiters, bartenders, that are also handling cash. So the opportunity to actually handle those assets is really all it starts. And again, I mean, this is a cash chapter. This also happens with supplies that a company has, inventory. That can happen to almost any asset that an employee could basically pocket and take out of the building. Right. So it all starts with opportunity. The next thing that really kind of happens is simply financial pressures. Now, we already live in a part of the country that has a high cost of living. In other words, we tend to pay a lot for renting our place. We tend to pay a lot for transportation, healthcare, education, energy. We tend to pay a lot of money for those types of things. And so we have a lot of families and a lot of individuals that are working with very tight budgets. So one little thing could go wrong that throws their whole financial situation out of whack, adds a lot of pressure to people. So that's one thing that's happening to everybody. Then put on top of this the idea that as human beings, we are prone to developing habits that are not good for us and actually cost money, such as addictions to alcohol or drugs that, of course, you have to buy with money. Addictions to gambling, and so, which of course means you're putting up a lot of money in some cases to gamble that away, and that doesn't have a very good return. There are some people that spend a lot of money on shopping. They go out, they shop, they actually buy way too much, more than they can afford. All of those contribute to financial pressure for an individual. So once you have individuals who work for you that handle assets of value, like cash, like inventory, and then you add to the part that they are subject to financial pressures of their own. Again, some of those are just living expenses that are very high in this area. And then you add on top of that all the frailties that we have as human beings, you got additional pressure. Well, that in and of itself isn't fraud. What happens is we start this process called rationalization. And just in general, rationalization is convincing yourself that it's okay to do something that's not okay to do, such as take other people's property. You learn this probably well before kindergarten, right? Don't take stuff that doesn't belong to you. Don't touch stuff that doesn't belong to you. Well, when you add this rationalization to the opportunity and the financial pressure, it sort of sounds like this. This is a multi-billion-dollar company. They're not going to miss if I take $20 and put it in my pocket, or $50 and take out put it in my pocket. That's rationalization. Well, it doesn't matter how big the company is. It's still not your property. It's the company's property. Or rationalization could also sound like this. I can't believe I didn't get that promotion, or I didn't get a raise and they gave it to some other person when it's certainly supposed to be mine. And I will get it back in one way, shape, or form, which means that, well, I deserve this. And so I'm going to take this. Again, you go back to kindergarten or before, you've learned don't take stuff that doesn't belong to you. So whether you're taking inventory and putting it in your car, whether you're taking cash from a company, that rationalization is simply convincing you to do stuff that's not okay to do. All right. So when all three of these things come together, employees that have the opportunity to handle assets, they're under financial pressure, and they feel as though they're in one way, shape, or form entitled to this through some rationalization that they have, you've got fraud. You've got the factors that contribute to fraudulent activity. Well, this has been happening for a long time. And again, that's a very narrow definition of what fraud is, what employees can do to employers. There is a long history of people and companies committing fraud. One, and this has happened a lot on the stock exchange in corporations. And so the government stepped in with something called the Sarbanes-Oxley Act. They actually dubbed it SOX, the SOX Act, which basically put some laws on the books for publicly traded corporations. Now, a publicly traded corporation, as you might recall from way back in chapter 1, is a corporation in which you and I, as members of the public, can be stockholders in, simply by buying a share of stock. So all the companies you see traded on the New York Stock Exchange or the NASDAQ, those are all publicly traded companies. And as such, they put out a lot of financial information to investors, to the public, et cetera. The Sarbanes-Oxley Act doesn't want any fraud happening there either. So this is what they required. So for the first time, they require corporations to put into place what we call a system of internal control. Put policies in place that stop fraud from happening, or if you can't stop it totally, that really reduce the chances that fraud or fraudulent activity is going to happen. And we're going to be focusing on this very soon in this chapter. Corporate executives, the president, CEO, some vice presidents, and board of directors, they must ensure that these controls are there, they're reliable, and they have been effective in stopping fraud. So here, again, these executives have been tasked with this through the law. They have to do this. Companies often have their books audited. They need to every year, in fact. So when an independent auditor comes in, it's usually an outside accounting company, comes in and checks the books of a corporation to see if they're doing the accounting according to standards, generally accepted accounting principles, right? Those auditors must attest, write down, sign, state, we've witnessed that this corporation has an internal control system in place. We attest to it. And of course, the Sarbanes-Oxley Act, SOX, up here, had to create a little bit of a bureaucracy to oversee that the laws were being done properly. So the Public Company Accounting Oversight Board is the creation of this act of Congress. And it's basically the administrative part, making sure that these companies are following the law. That's that. Oh, sorry. So let's talk a little bit about this idea of internal control, because this is what we're going to focus on today. So companies have to put together methods and measures to do this. This is probably the most important thing they have to do. The assets of the corporation belong to the corporation. So whether it's cash, whether it's supplies, whether it's inventory, whether it's equipment, it belongs to the corporation. It cannot be taken away by employees or anybody else just because they have access to them. So these internal control measures really must safeguard the assets. They do a few other things. The accounting records will be a little bit more reliable and accurate if we're making sure we have those assets in place. The operations should become a little bit more efficient. Companies should be a little bit more efficient at getting things done because these measures are in place. And of course, the companies have to make sure they're in compliance with the law, that they're actually doing all these types of things. So let's take a look at some components. And there's 5 primary components we're going to look into. Okay. So the primary components include that there has to be an environment in which control is a central theme. Right? There has to be an assessment of what risks are there for fraud and how are we addressing them. There has to be we have to look at the activities that are taking place and whether those activities could lead to fraud, and if so, how can we put controls in so they don't. We have to make sure this information is available and communicated to all employees so they understand how things work. And then, of course, we have to monitor everything that's going on. Okay. This is something that you probably have seen in your jobs, and I know a lot of you have worked, in some cases, several jobs. So if any of this kind of rings a bell and you have something to comment on, you're more than welcome to chime in, no problem. So here are some principles of internal control activities that you might have experienced at your job. 1, establishment of responsibility. So in essence, make sure that there's usually one person is responsible for a given task. Now, that's very important because that one person now is fully responsible for whatever's happening. Look at the little illustration here on the right. This is true for cashiers at cash registers, right? Having your own cash drawer assigned to you is an establishment of responsibility control activity. Because they're basically saying, look, you're given this draw, you're the only person who has access to this draw, and so you're the only person who's responsible for anything that's happening with this draw. And so if we give you a certain amount of cash at the beginning of your shift, you're collecting cash through your shift. At the end of the day, that cash needs to balance, that draw needs to balance. before you can get out of here. So that's one of those types of things. All right. So some companies don't have a drawer policy per employee because you still have some companies that share uh, access to a cash register. So there's other ways in which you can limit access to people who you've authorized, right? So you can give certain cashiers codes. So when they approach a cash register, they will put in a code that tells the system they're the ones who are working on this transaction and they're the ones that are responsible for that particular transaction. And so as everyone uses it, they're using their codes. And so as they notice maybe something might be off at certain times or certain periods, they know exactly who's been in the drawer because all the codes identify everybody. Okay. And so that's really important. Another internal control activity is to segregate the duties of work. Okay. So different people should be responsible for related activities. So no one person controls the entire activity. Because once you have one person who controls the entire activity, then you're basically, that could be an environment for fraud to occur. Okay. So look at the illustration on the right side here. So part of segregating duties is you have employee A who is simply doing the bookkeeping of how much cash we should have. Employee B actually has the cash on hand. Those two employees should have the same record for cash. Okay. So that's part of segregation of duties. You have, two or more people that are involved. They're in a related activity, but yet it's separate. It's segregated. So it reduces the risk of fraud from happening. Okay. And other ways companies do it is to use documentation. And so almost everything you get in a large company, again, this is public corporations, you're going to have everything, it's going to be documented in some way, shape, or form. So here you have pre-numbered invoices. Again, the goal is to make sure all the documents in this particular order here are going to be accounted for. It's a record. It's a record. And employees need to promptly forward those documents for entry to the accounting department. So that yet separates that particular duty. And so these documentation procedures are very, very important to make sure everything is documented. You've all probably noticed physical controls in one way, shape, or form on your job, even as a shopper in a store. You've seen them. One thing, of course, is we mentioned already that you might need a passcode to access a cash register or some other area. So there are passkey access, whether it's fingerprint, eyeball, code, what have you. Those are important. Another thing you'll see as an employee is there'll be a record of your time, and that's because one thing that employees can steal is time. So saying that you worked 8 hours when you really worked 7, you're stealing an hour's pay from your employer. So time clocks have changed a lot from back in the day. A lot of people now have to swipe in, their ID and swipe out, and et cetera, to sort of that in. Some businesses don't have any time card records. It's still kind of kept by hand or on a larger schedule. You'll have certain personnel that have limited access to warehouses and cabinets where there's inventory stored or various records that are stored. Because again, inventory can easily leave the warehouse in an employee's vehicle, and that's not the purpose of it. It was to be sold. You also know that a lot of places might have a safe in the back. Restaurants handle a lot of cash, bars, etc. They'll probably have a safe somewhere in the back to stash all of that for safekeeping. But again, you have other bigger companies that might have vaults and other types of places where cash or important business papers are being kept, right, with only so many people knowing the code to get in. You've certainly seen that buildings are protected with various alarms to prevent break-ins, whether they're breaking in to steal cash or inventory is irrelevant. It's still a physical control. And then as a shopper, you've probably noticed all types of tags and monitors on your on things that you might have been purchasing. It's a real pain in the behind when they forget to take those things off, particularly of clothing. That's happened to me in the past. But all of these types of things are monitored because inventory is where retail stores make all their money. They sell inventory. They can't afford to have it being taken. You probably know there's television monitors and cameras, secret shoppers, all types of things going on. All of those are meant to be physical controls to keep that inventory safe. One thing that a lot of bigger companies can do is they can actually have what we call internal verification. Someone who knows the area but is not directly responsible for what's going on, but can verify it. So we'll go back to employee A and B, where employee A is simply doing the books on cash, how much cash we have, and doing the bookkeeping on it. And the other employee here is actually holding the cash, physical cash. Well, there might be a third party, like an assistant treasurer, who kind of knows the system, who can verify independently that, yeah, this is correct. Everything's balanced, everything is fine. They're also if there is any difference, that's called a discrepancy. And those discrepancies are reported to management right away. Human resources are even involved in it because, believe it or not, it's important, internal control activity. One thing, if you're going to hire an employee who handles cash or who handles inventory or other types of things, you're going to want to have that employee bonded. Okay. And bonding, we're not talking like 50 Shades. We're talking accounting, which is, in this case, it's insurance. Bonding of employees is simply ensuring you have insurance on the employee in case they take something from you. Then the insurance covers the loss that you have. And so the bonding process is really about insuring employees. Okay. They can only hire you if you're insurable, which is what the background check is really sort of about. Can they get insurance on you? One of the most important things that they'll pull, I'm sorry to spell, is something called a query. It's supposed to be an R. CORI. It's a criminal offender record investigation or inquiry. And basically, it's not necessarily a rap sheet, but it is one of those types of things where it really does go over arrests and whether you were convicted of any crimes. So this is, I mean, it's supposed to be used in a secure way, because if I see on your query report that you have been convicted of stealing, whether it's someone's car, someone's property, what have you, that might make you impossible to insure. So if I can't bond you, I can't hire you. Okay. And so that's basically what we're supposed to be connected to. Of course, as you probably guess, they can be abused like anything else in our world. What it's not supposed to be done with a query is if you had some type of a conviction of something that's not related and does not pose the same risk. So, you got caught and booked, smoking pot or driving while you were, high. Well, technically speaking, that shouldn't really interfere with you getting a job as a cashier. It might interfere with your job if you're applied to be a truck driver or a delivery driver, because being high while driving is like being drunk while driving. It's not compatible. It's risky. And so they probably would not want to hire you to be a driver, but there's no reason not to hire you to be a cashier. So again, it really kind of depends on how it's used. It's supposed to be used for the very best purposes there to see if it's related and you're insurable. Another thing too is to rotate employees around. So let's say you're in a supermarket, you're on the cash register. So you're doing that for a while, then you rotate to do the bagging, then you rotate to do customer service, then you rotate to do stock and restock the shelves, and then you rotate back into a cash register type of thing. So rotating the duties helps management see if there's any differences. So when person X was the cashier, we collected this much on this many sales, and when person X is no longer the cashier, we see that goes up a lot, So is there something going on? So that's basically what the rotation is sort of about. And requiring vacations is also very important because if you're on vacation, everything should be the same. Okay. And so in this case, this little guy here says, if I take a vacation, they'll know I've been stealing. Right. So this is another reason to require vacations, because while the person is gone, if you should be noticing various things. Everything should be the same, but if you start noticing the differences, that's a discrepancy that needs to be reported, and that will be investigated. Okay, so let's take a look at a few frauds here. Okay. So here we have Maureen Frigali. She was a training supervisor for claims processing at Colossal Healthcare. Okay. So as a standard part of the training program, she created fictitious claims for use by whoever she was training. So they were supposed to be fictitious claims. Those claims were sent to accounts payable for payment. After the class ended, she would notify accounts payable to say, look, this claim, part of my training, don't pay them. However, she did not inform AP every time. In fact, she created some fictitious claims for entities that she indeed controlled, and she let accounts payable pay her. Her take was, as the name of the company suggests, colossal, 11 million bucks. That's a lot of money. That's a whole lot of money by any stretch. What was the missing control? Well, there was no clear establishment of responsibility that was part of the internal controls here. The company did not adequately restrict the responsibility for both authorizing and approving the transactions. In this case, she was able to authorize and approve. So again, she should not have gotten access to the live system, and none of those claims would have been paid, and she wouldn't have taken all that money. She's got new friends in jail now. Here's another fraud. Lawrence Fairbanks, we'll just call him Larry, the Assistant Vice Chancellor of Communications at ASOP University. He was allowed to make purchases of under $2,500 for his department with his signature. No approval necessary. He could just do it. Unfortunately, he loved expensive antiques and bought a few for himself. Why not? Well, how did he do it? Well, he certainly replaced those invoices with fake ones. Okay. The fake invoices were basically more consistent with what his department purchase orders would look like. Then he submitted them for payment. Okay. And he got paid. How much? Well, almost $500,000. Now, for a university, that's a lot of money. That's a lot of money. That's a whole lot of money. Never mind a whole lot of antiques. So what was missing? Well, there was no segregation of duties. Larry had too much power in his position because he could order the item, he could receive the item, and he also got the invoice. Okay, which means he was able to manipulate that invoice for payment. So, usually if it's okay, there's purchasing. I mean, there's a purchasing department. They do the purchasing. That's perfectly reasonable. But you usually have another department do the receiving. And yet another department is responsible for payment of all that stuff. And these three were all basically up to Larry to decide. And thus fraud occurred. But had they segregated the duties, Larry would have been a little bit less antique-y. Angela Bauer here was an accounts payable clerk for this construction company that I cannot pronounce, Agassiz Construction. Well, as an accounts payable clerk, she had quite a number of duties. Matter of fact, she was able to prepare and issue checks. Oh, that's important. And she was the one who reconciled the bank statements. Now, that's a real critical thing because who else knows what's happening in your cash account? Well, you know what's happening in your cash account, but also the bank has a record of what's happening in your cash account because that's where your cash account's located. So they keep a record of that. So this is how she was able to do the fraud. She wrote checks for costs that the company had not really incurred, okay, like fake taxes. A supervisor would sign off on it. And then she got busy. She'd white out the payee line and she'd change it to her personal account, okay, and put it in her account. Well, how was she able to conceal that for so long? Well, she was able to conceal it because she reconciled the bank account. So she saw what the bank account saw, which is payment to her, and she never told anybody. And she was the only one who was doing that job. So obviously no one else knew. So that's a problem. How much did Angela take? Over $500,000. That's a lot of construction, for sure. What was missing? Well, again, there was no segregation of duties here either, okay? Because Angela was able to do everything. She had physical custody of the checks and she prepared the bank reconciliation, which was about the checks. So no one else had another look. No one else had a second look. Those duties should have been split, given to somebody else. So something could have been flagged. Okay. Let's talk about another fraud. What else is there to talk about today? Here we have a company called Mod Fashions. And they send employees on a lot of trips, right? Because that's what you got to go where the fashion is, right? So they sent a bunch of employees on lots of trips for them. So what happens is after you go on a trip, you submit your receipts to get reimbursed on any costs that you had. the company had a few things. They could actually, they told the employees, look, you can either submit the receipt for the bill, or you could submit your credit card receipt, or, too many ors here, you can give me a copy of your credit card bill and we'll pay it. So there were a few designers that traveled very frequently, were very, very friendly, and they decided to collude. This is what collusion is. Collude to do a scheme for fraud. They decided, okay, we're going to submit a claim for the same expense, but you, and it's a $200 meal, but you're going to actually submit the detailed meal bill we got from the restaurant. And you, person number 2, is going to submit your actual credit card receipt. And you, person number 3, is going to submit the credit card bill showing the meal as an item. And that way, all 3 of them were able to collect the $200 receivable. So instead of getting $200 back for a full meal for all 3 of them, they each got it, which was $600. Now that in and of itself might not be a huge fraud, but this was happening for a while. It took over $75,000 from this company. Okay, so what was missing? Well, documentation was all screwed up, because you could do one, this, or that, and they caught on after a while. Best is don't accept any photocopies. It should be the original detailed receipt from the store or restaurant, taxi, whatever you have. Best is, you want to stop this type of thing, instead of having them use their personal credit cards and submitting them, just give someone the corporate card. And that way you know what the expenses are for the trip. And only one person can use it, so you know exactly everything. So that's probably the best way to do it. Okay. Now there are a few more frauds that are here that you're going to read about. Again, people taking lots of money with a missing control. You're going to read about all of these. This particular control, no internal investigation. This particular control, human resource control, was missing. So you're going to read these, which are all part of your book, to be able to understand how to do your homework. But of course, like anything, there's pluses and minuses, right, to every system. So what are the limitations to internal control? Well, sometimes it might cost a little bit more money than the benefit of stopping it from happening. So costs have to be reasonable when you implement an internal control system. Okay, they can't be unreasonable. Well, there's that human element. We cannot design a perfect system because we are imperfect. So whatever we try to do, we might be doing our best, but even our best is going to be imperfect because that's how we are made. So any system is going to have that human element. And we also are going to have people who are going to try to get around things one way or the other, and try to game the system. So there is that human element at play on a bunch of levels. And the size of the corporation matters because the smaller the corporation, the more likely you're going to have people doing more than one job. It's much harder to segregate certain duties. It's much harder to do various things if the business is much smaller. And you do rely on folks to do a whole bunch of stuff. So there are some limitations, there's no doubt about it. Okay. So your do it exercise here in review shows you and asks you what control activity is being violated with the following things. So number 1 here, the person who is reconciling the bank account, which shows all the cash going in and out, and making all the deposits is the same person, the company accountant. Well, that violates segregation of duties because those are very important. What if the accountant just decides to pocket this bank deposit he or she's the only one who knows that happened, because they're the only ones who make the deposits. They're the only ones who see what's happening on the bank statement. So no one else is going to be able to know. So that's ripe for fraud. Segregate those duties to break it up. Another person here, which is the treasurer of this company, Wellstone Company, received an award for not having a vacation in 30 years. Well, you probably know why. Who doesn't like a vacation? Right? Probably because they were up to some no good. And so human resource controls, in essence, forcing them to take vacations, in essence, might have been able to provide the hints that something was going wrong from the beginning. Lastly here, this particular company, a local restaurant, doesn't buy any pre-ordered or pre-numbered order slips. They basically, don't do it. They want to save money. Well, that's ripe for fraud as well, because there's no documentation on what happened. And it's even worse that it's a local bar or restaurants, because a lot of those types of things, there are a lot of cash businesses, and a lot of cash is handled. And, if it's not properly documented, it's probably going somewhere else. Or at least that's the risk that needs to be avoided. Right. All right, so that is Chapter 7's review. Questions?